Hello, and welcome to this Family Building Society podcast, where we'll be taking a closer look at mortgage affordability, the role of the bank of mum and dad, the impact on their financial resilience, and what more could be done to support families. I'm Samantha Partington, freelance journalist for Mortgage Solutions, and today I'm joined by two of Family Building Society's mortgage experts and business development managers, Neil Cadwallader and Arif Kara. So at the start of the year, Moneyfacts brought out data saying mortgage affordability had gone back to levels seen in 2023. But 4 months on, and UK Finance has released its statistics, showing that in some parts of the UK, particularly East Anglia and the London commuter belt, affordability is the worst it's been in 18 years. So I wanted to ask you both what your take on mortgage affordability is at the moment. And Arif, perhaps if I could start with you.
Yeah, sure. Sam, thanks for having us. Thanks for hosting. So I would probably echo both publications from both those companies because we did start the year, especially the first couple of months, where it was quite steady. We had steady rates. The thought process within the market was, okay, we're going to get a couple of base rate cuts. Affordability was comfortable. Inflation, you know, wasn't where we wanted to be, but it was settled. So, because inflation and ONS data reflect affordability, all those outgoes are factored into the affordability calculators with all lenders. So it was good. Salaries were where they were, so we were getting used to it. It was fine. Then obviously, hell let loose towards end of February, beginning of March. Quite a few lenders pulled their rates. Affordability became a bit more stringent, which naturally had an impact on affordability and mortgage calculations and how much we can lend to clients. It feels like, and it seems like, the confidence is coming back. Lenders are becoming more comfortable and more relaxed with their affordability. So it seems like we had sort of up, down, and we're back on the up sort of thing. So that's how it feels like from my sort of real life experience.
Yeah. Mortgage rates definitely started to come down across the board, which is really promising and quite sizable decreases as well. So it seems like at the moment they're starting to come down as quickly as they went up, which isn't always the case. Neil, where do you think we are with mortgage affordability at the moment?
Yeah, obviously there's quite a few factors in there. I think that the inflation rates have just come out as of, I think it was this morning actually, 2.8, dropped down from 3.4. That's off the back, obviously, of utility kind of pricing, which has been on everybody's mind, obviously, since everything that's happened abroad at the moment. Um, Looking at swap rates, so swap rates are softening around the 2-year mark. 5-year mark have softened a little bit. 10-year mark actually slightly increasing. So I think obviously the markets do try and price in for future. So that's something to be mindful of when looking at it. Although, as I said, the 2 years are softening a little bit at the moment. The markets, as of this morning, we're talking about rate cuts as well, and because everybody's held with some nice juicy rate cuts this year. I think we'd be lucky if there's no rate rises at the moment, if I'm totally honest. But uh, as you're echoing what Arif has just said, in the last couple of weeks, it's almost as if the markets have reset a little bit, and then that obviously follows on to pricing, because it's very, very mindful for people at the moment that if they are going to remortgage to do something, or they're going to move house, is what will the future bills be? Affordability stroke ONS has timed a little bit lately with those bills. But at the end of the day, it's all down to also the flexibility of the lender, of what incomes and so forth they can take, which we can be very flexible with family. But going forward, things are looking a little bit brighter than most definitely did when it was mid-March.
So moving on then, what consumer trends have you noticed that point to the difficulties of first-time buyers getting onto the property ladder?
I think there's a massive focus on cost versus renting versus cost versus mortgage, which traditionally it's always been seen to kind of be cheaper to rent than it is to actually buy. I think with the rent increases happening and the housing stock shortage in the rental market pushing those monthly bills up for the rental market, things starting to kind of shine a light on it's cheaper to get a mortgage. which is really kind of really good going forward, because obviously, at the end of the day, if they're paying a mortgage back, they're paying their own mortgage back, not somebody else's. So from that point of view, it's very good. Housing stock is a big one, because the amount of housing stock on the market for sale dropped quite dramatically towards the end of last year. Beginning of this year, it has been a little bit stifled, especially demographically in certain areas. Housing prices, mind you, have actually dropped, which isn't that's going to help everybody, really, to be honest. And you know, I've had quotes from brokers dealing like kind of like in the West London market, that kind of the pricing is kind of almost down to like 2017 times, you know, so that helps again. So albeit there are difficulties out there getting on the property ladder, because obviously while they're renting, they're not actually getting not able to amass a deposit either. But there are great schemes out there, like we have at Family, for that. And then obviously reliance of the bank of mum and dad, which I'm sure we're going to go into in a little bit more in a bit.
So I wanted to come on to family help. How important is financial help from the family becoming with regards to home ownership? Is it essential, Arif?
Probably, I mean, from what I'm seeing, from what we're seeing, especially the kind of lending that we do, because we do a lot of guarantor mortgages, we do family system mortgages, and we're we're in a sort of situation where I think an average price about 8 times someone's annual income, and you'll be lucky to find a lender that would lend you 8 times income. I mean, if there's any great, well, not to my knowledge. So to push that extra gap between what the clients, the younger applicants themselves can borrow, that's where parents come in. And, you know, there are many ways parents can help. They can help with their money. They can help with with their income by jumping on the mortgage. So yes, unless you're a very high earning first time buyer, parental help is required more often than not.
And Neil, what do you see?
Yeah, definitely. It's becoming more and more. I see that gifted deposits and kind of family members rallying around not only younger buyers, because it can actually be older buyers as well. There's a bit of a stat that I saw was and I'm looking at so over the last 4 years, the bank of mum and dad has actually donated, in inverted commas, 38.5 billion pounds towards the mortgage market, which is kind of absolutely, you know, kind of massive as such, and 9.6 billion pounds in the last year. And that's just within the UK mortgage market. So it is obviously a very large chunk of money that's been passed down. And, you know, as Arif has alluded to, it doesn't necessarily have to be directly given. It can be portioned off with products like the family mortgage, where, you know, we can actually gain benefit from money, but it doesn't have to be directly given. So there's loads of innovation out there as well to help them on the ladder.
Yeah, I mean, it brings me to my next point. You know, that figure that you said is staggering, and I saw a similar some data that came out from Savills, where it showed that 52% of first time buyers relied on the bank of mum and dad, and receiving on average £55,000 as a gift, and that's a huge sum. And I wanted to sort of, you know, ask you, Neil, what the impact on the bank of mum and dad. They're going through the cost of living crisis like everybody else. They may not have a mortgage anymore, but they're certainly paying high energy bills. You know, they're going to be feeling a squeeze in the budget. So how does having to hand over a gift like that impact their financial resilience, and what other options are there for them?
I always kind of say, kind of family building society, or we can kind of lend into quite kind of, we can go to 95 years of age on lending. And so when we're talking about maybe a younger family member wanting to get onto the property ladder, sometimes it may not be just a direct guarantee being held by an older family member. It may actually be an older family member that might be doing a capital raise to gift. You know, since we're kind of going down the old stat route, there is a stat there, which has actually been compiled by the FCA, believe it or not, that over 55s, the amount of equity in UK property is £3.7 trillion. Most of them baby boomers. So, that is real untapped kind of source of money that can be gifted to younger family members and so forth. So where the mortgage comes, it may not actually be just the younger person. There may be an older person that may be able to take out a mortgage to gift, and then the combination of the two will get that person on the property ladder.
Do you think, Arif, that there's enough innovation then in this part of the market to support families, to support intergenerational lending, or does it need to be better catered for?
It's a very relative question, Sam. Depends on when you're looking from. If you're looking now compared to 2 years ago, compared to 5 years ago, 10 years ago, we're definitely in a much better place. I mean, we do 100% mortgage. There's a couple of lenders that will do 100% mortgage. You've got plenty of 95% deals available. But does the market need more innovation? It definitely does, because we need to somehow come to a conclusion that these younger generation who want to get on the property ladder, their salaries are never going to be sufficient with the income multiples being borrowed to them by lenders to be able to buy what they want to buy. So there needs to be a median solution between lenders and consumers. And I think that's where families come in. Families are, it's a new phenomenon for the families. Guarantor mortgages, allowing a charge to be put on your property for 5 years, for example. That's what our 100% mortgage requires. Or, mum and dad are retired now. They want to enjoy their retired life, but the kids say, no, can you jump on the mortgage with me on a joint or sole proprietor? It's a new phenomena. And I think there's a big educational piece that needs to be directed towards parents, which I think is slacking a little bit, and slacking because the younger generation understands the actual process and how it works. But the parents may think, okay, I'm not too sure about this, but there isn't much risk in it for them, very limited. So we're in a much better place than where we were, but there's definitely more room to go.
Well, we've run out of time for this episode. That was all really interesting. Thank you for listening in today. Hope you found that useful. But please do join us again for the next episode when we discuss low and no deposit mortgages.